Hi everyone, welcome back. Today, I want to talk about a very interesting development at the intersection of AI, semiconductors, and Wall Street. You may have seen the recent news connecting NVIDIA with a plan to mobilize more than $500 billion for AI infrastructure. $500 billion is a huge number. But what exactly does it mean? Where is this money coming from? Who receives it? Who could benefit from it? And perhaps more importantly, who takes the financial risk. First, let's clear up one important misconception. NVIDIA did not raise $500 billion. Instead, NVIDIA is working with major financial institutions, including Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR, to establish financing platforms intended to mobilize more than $500 billion of third-party capital for AI compute infrastructure. So this isn't simply another NVIDIA fundraising story. The much bigger story is that Wall Street is beginning to build a financing ecosystem around AI infrastructure. And that could have important implications not only for NVIDIA, but for memory companies, semiconductor manufacturers, AI infrastructure providers, and eventually the entire AI investment cycle. So let's start with the first question. Why does AI need Wall Street at all? Why does AI need Wall Street? Because building AI infrastructure is incredibly capital intensive. An AI factory isn't just thousands of NVIDIA GPUs. You also need high bandwidth memory, networking, storage, data centers, enormous amounts of electricity, cooling systems, land, and physical infrastructure. The technology may exist, the customers may exist, the demand may exist. But somebody still has to provide billions of dollars upfront before that infrastructure starts generating revenue. And as AI infrastructure moves toward enormous global scale, technology companies may not want, or be able, to finance everything from their own balance sheets. So one of the biggest constraints on AI growth may increasingly become something very traditional: capital. And that brings us to the next question. Where does all that capital come from? And that's where Wall Street enters the story. NVIDIA is working with some of the world's largest financial institutions, including Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The idea is to connect enormous pools of global capital with the rapidly growing need for AI infrastructure. Depending on the specific transaction, that financing could potentially come through debt, equity, private credit, infrastructure financing, or a combination of these structures. So there isn't necessarily one single financing model, but the basic idea is actually quite simple. Global capital flows through financing platforms into AI infrastructure. Instead of technology companies having to finance every new AI factory entirely from their own balance sheets, outside investors can provide part of the capital. And once we understand that, the really interesting question becomes, where does that money actually go? And who ultimately gets paid? Now let's follow the money through one simplified transaction. Investors or lenders provide capital. That capital flows through a financing structure to an AI infrastructure company. The company receives the financing and uses that money to build AI capacity. It buys NVIDIA GPUs, it buys HBM memory, it buys networking equipment, and it pays for data centers, power, cooling, and other infrastructure. And this is where we get to one of the most important financial ideas in this story. One company's financing can become another company's revenue. The AI infrastructure operator takes on financing, while NVIDIA, memory suppliers, networking companies, and other infrastructure providers receive revenue when the equipment is purchased. Then the AI operator sells computing capacity to its customers. Those customers pay for compute, generating cash flow that can ultimately be used to operate the infrastructure, service the financing, and provide returns to investors. But there's an important point here. Financing is not free money. If the financing is debt, somebody has to repay the principal and interest. And that creates two very different sides of this story: the companies receiving and spending the capital, and the investors providing it. Before we look at those risks, though, let's first see which companies across the AI ecosystem could potentially benefit from all this spending. So NVIDIA isn't necessarily the only potential beneficiary. If easier financing leads to more AI infrastructure being built, that spending can spread across the entire semiconductor and data center ecosystem. NVIDIA is the most obvious example. More AI factories could mean more demand for GPUs and AI computing systems. But those GPUs also require enormous amounts of high bandwidth memory, or HBM. That could potentially support demand for memory suppliers such as SK Hynix, Micron, and Samsung. More advanced AI chips can also mean more manufacturing demand for foundries such as TSMC. And an AI factory needs much more than chips. It requires high-speed networking, storage, enormous amounts of electricity, and sophisticated cooling infrastructure. AI infrastructure and cloud operators could also benefit because access to external financing may allow them to build capacity faster. But there's an important distinction here. These companies are potential indirect beneficiaries if financing leads to more AI infrastructure spending. That does not mean they're all direct participants in NVIDIA's financing initiative, so the opportunity can spread across the ecosystem. But what about the company actually receiving the financing? That's where leverage enters the story, and where the risk starts to become much more interesting. Now let's look at this from the perspective of the company actually receiving the financing. For that company, the biggest opportunity is leverage. Instead of funding an entire AI factory with its own equity, the company can use outside capital to build substantially more infrastructure, much faster. If demand for AI compute remains strong, that can mean more capacity, more revenue, faster growth, and potentially higher returns for shareholders. But leverage works in both directions. What happens if utilization falls? What happens if compute prices decline? Or what happens if a new generation of GPUs makes today's hardware much less competitive? The value and earning power of the infrastructure can fall very quickly, but the financial obligation may still remain. And that's the fundamental risk. The asset can depreciate, the debt doesn't. So financing can amplify the opportunity when things go well, but it can also amplify the losses when things go wrong. And remember, there is another side to every financing transaction. Someone is providing that capital. So next, let's look at the opportunity and the risk from the investor or lender's perspective. Now let's look at the other side of the transaction, the investors and lenders providing the capital. For them, the opportunity is very different. Depending on how the financing is structured, they can potentially earn interest, fees, and infrastructure-style returns, while gaining exposure to the growth of AI without actually operating an AI company themselves. But they're also taking financial risk. The most obvious risk is that the borrower could default. But there's another problem that's particularly interesting when you're financing AI infrastructure: technological depreciation. Think about traditional assets. A building can remain valuable for decades. An aircraft can operate for decades. But AI hardware evolves incredibly quickly. So a lender financing today's AI infrastructure eventually has to ask a very important question. What is today's GPU worth 3 years from now? If the borrower defaults and the underlying GPUs and other hardware have lost much more value than expected, the lender may discover that the collateral isn't worth enough to recover the financing. And this is where something very interesting happens. Technological risk becomes financial risk. And once large amounts of credit become connected to AI infrastructure, this could have implications far beyond individual borrowers and lenders. It could actually change the dynamics of the semiconductor cycle itself. And this brings us to what may be the most important implication of the entire story. AI is no longer only a semiconductor story. Compute is increasingly becoming infrastructure. And infrastructure can be financed. That means credit could become an increasingly important part of the AI and semiconductor cycle. When confidence is high, more credit can finance more AI factories. More AI factories can create more demand for GPUs, memory, foundry capacity, networking, power, and cooling, and that can reinforce the expansion. But the same mechanism can also work in reverse. If AI returns disappoint, borrowers struggle, or infrastructure assets lose value, lenders may become more cautious. Credit can tighten. AI capital expenditure can slow. And semiconductor demand can weaken. So credit could potentially amplify both the boom and the downturn. And that's why the real story isn't simply, is $500 billion bullish for NVIDIA? The much bigger question is, what happens when the AI revolution becomes financed by Wall Street? And that's the question I think we should be watching as this new AI financing ecosystem develops.